Hello. So May-June 2021 session of the Business Studies, IGCSE Business Studies, paper 11. So I'm going to focus on question 1. And as you can see there on the slide, you would encounter some topics about public sector, profit, business size, stakeholders' objectives, economies of scale, plus some of my explanation on the public limited company, shareholders, and private sector. Take note that the purpose of this video is for me to help you in answering the Cambridge exams. At the same time, it's also a way for me to lessen my burden when it comes with explaining some topics in the classroom. Okay? Let's start. What is the question number 1 of paper 11, May-June 2021 session? So what I'm going to do is I'm going to read first the whole text, and then I'm going to explain, okay, how are you going to answer this kind of question? So here, BKH is a large public limited company. So it means when I underlined, okay, something with red line, it means that it's a big idea, okay? There are big ideas. Large public limited company. It has 2,000 employees across 18 locations. So we all know 2,000 employees means 2,000 workers across 18 locations, and location means place. BKH sells a range of insurance products. So that is the kind of product, it's insurance, okay, including house and car insurance. BKH shareholders, again, shareholders want the business to increase profit. And we all know to increase profit is what we call a business objective. The managing director, okay, who's responsible of some projects and whatsoever, knows increasing profit can conflict. Okay, there's a word named conflict, also known as a problem, with the objectives of other stakeholder groups. Again, stakeholder, shareholder, are they different from each other? Okay, stakeholder, shareholder, are they the same because they have the word holder? Okay, she said private sector businesses, okay, have different objectives to public sector organizations. So you've got the sector businesses, private and public. They are different, okay? BKH is also planning to expansion, okay, because there will be growth by taking over is a technique, okay, for you to have a business growth, another insurance company. So that is the question or the text for question number 1, paper 11. What you will do is for you to underline the big ideas. So you have to identify what are the big ideas, and from those big ideas you will know what you're going to do afterwards, okay? Because in analysis you have to choose what are those big words. You have to identify the big words. So you can see there, the big words are the large public limited company, shareholders, profit conflict, objectives, stakeholder groups, private and public sectors, insurance, and takeover. These are the important words that you need to use, okay? You need to know in question number 1. Now, after knowing the big ideas, then you need to break it down. Okay, so I have broken down the text itself, and of course I'm going to use the underlined words for me to explain some big ideas. For example, the public limited company. What is that public limited company? Well, public limited company is It's a limited company. Yeah. Public limited company is part of a joint stock company, which can sell shares and stocks. So when we say public limited company, it is an incorporated business. Yeah, it's not on my slide, but it's in my explanation. So incorporated business is a kind of business that exists separately from its owners. There's a separation between the business and the owner. And in a public limited company, you are going to buy stocks or share in a stock market. Okay, it's in the stock market. So, how can I say this? In the stock market, you can choose what company you would like to buy shares or stock. And once you have bought shares, you are now called a shareholder. Shareholder is the owner of shares. Yeah. Shareholder is the owner of stocks. And every month, okay, you as a shareholder, because you own a certain uh, percentage of this company, you will receive a part of the profit. Okay, and that part of the profit is what we call dividends. Dividends is the return of investment. Another, take note that the word shares, okay, shares are unit of ownership. Okay, again, shares are a unit of ownership. So each one, okay, each share represents an equal part of the company, equal part of a company's capital. Okay, because you um, you have bought, okay, you buy a company's capital, so you own, okay, a share of it. That's why you are called a shareholders. Another, people would love to, anyone, okay, anyone can own shares in a public limited company. But of course, if you are a minor, I think it's gonna be difficult for you. But if you are, if you're in a certain legal age, then you can really own shares. What else? Public limited companies also uh, is a type of company which can raise a very vast amounts of money. Okay, because it will be sold in the market, in the public, in all the people of the world. Okay, you can you can really buy it wherever you are. Okay, another is it's a limited liability. Okay, a public limited company's advantage is limited liability, which means that you as an owner, okay, um, is only liable for the amount invested in the business. A limited liability meaning to say that if the business will have some debts, then you don't need to use your personal money to pay for your debts. Another is you can able to sell your shares. Okay, if you buy your shares, then it's easy for you to sell it. And where are you going to sell your shares? At the stock exchange. Okay, so you can buy, you can sell in stock exchanges. And if you don't feel that you don't have any dividends anymore, if you feel that you don't have any profits with this company, then you can sell it in the stock exchange. Another is, yeah, as I've told you, a public limited company is incorporated. Incorporated meaning to say that this is a kind of business that exists separately from its owners, and people would love to buy shares because of the continuity of existence. Because it's so big, then there's a big chance for them not to face bankruptcy, or because it's too big, then it will run in the future, like in the very, yeah. I mean, there is the was that security when it comes with getting your dividends. Okay, another one disadvantage of a public limited company is it's very expensive. Okay, because it's a huge business. Another uh, another disadvantage of a public limited company is a takeover. So it's kind of survival in the fittest when it comes with the market. So there's the kind of competition with all the PLCs around the world, and of course, you need advertising, you need advertisement, you need to make sure that your company is popular, okay, among all the uh, other public limited companies, or else you're gonna deal with the bankruptcy or you will be dealing with a takeover. Okay, that is the idea of the public limited company. Now, when we say insurance, it means that it's a contract. Okay, um, uh, as you can see there, an insurance is a type of the tertiary sector. Okay, so it's a service industry. So insurance meaning to say, for example, like I buy a house. Okay, I have bought a house, and every month I would pay $50 for my house insurance. Okay, $50. Yeah, it's very costly because you've got a big house. And then after 1 year, okay, um, something happened with your house, like it got burned. Okay, there's a disaster in your house, and you don't have any cash for you to fix your house. But then again, you've got your insurance, your house insurance. So, you know, for you to be protected financially, then you need to use that insurance. Another is like you bought a car, and then all of a sudden, and then you paid for the insurance, and all of a sudden you've got a car accident. Okay, and of course, what will happen to your car? Since that you've got the car insurance, you're going to use it so that you can replace it to into another car, okay, which is, brand new. So that is the idea of insurance. So BKH is a tertiary part of the tertiary sector. Okay, BKH is a service part of the service industry. Now, another is here. BKH shareholders want the business to increase the profit. Remember that a shareholder needs to get dividends, okay? And the word dividend means the part of the profit. And who is responsible of increasing the profit? Is it the shareholders? Yeah, it can be, but then again, the most responsible for increasing the profit would be the people that they have elected. So remember, if you're a shareholder, you have this what we call you have this right. Okay, there's a privilege for being a shareholder, wherein you're going to vote for the board of directors, and the board of directors will vote for the CEO, okay, the chief executive officer. So if you hear the word CEO, then that company, company which has a CEO, it means it's a limited company. Okay, so a shareholder would attend a meeting, and that meeting is what we call the AGM, annual general meeting. And in that AGM, the shareholders, all the shareholders would vote for their representative who will do the day-to-day activities. And they are, of course, the board of directors, and of course, they will vote for the CEO. Now, of course, the primary objective of any company is to increase the wealth, increase the profit, to increase the dividends of its shareholders. Okay? Because the shareholders elected the board of directors. So the board of directors and the management and the CEO are responsible for increasing their dividends. And the result, the shareholder value. Again, the shareholder value is the endpoint or the goal of the company. Okay, because the shareholders believe that in the future, in the long run, they will get profits. And how can they get the profits? If they are going to elect better, company members. Okay, so next slide is this part of the dilemma coming from the managing director. So the managing director knows increasing profit can conflict with the objectives of other stakeholder groups. Yes, I'm saying here the stakeholder concept. And the managing director said that the private sector businesses have different objectives to public sector organizations. We all know that the concept of business objectives are the targets or the aims that the business sets out to achieve. Okay, so each stakeholder groups, okay, a stakeholder is an individual or the group impacted by the business activity. They are people or groups of people who can be affected by. Okay, these are the group of people who have an interest in any action of any organization. Um, the idea here is stakeholders can affect the whole market. Anything, okay, anyone who is involved in the business activity is what we call a stakeholder. Okay, there are some people who are inside the businesses, like the owners, the shareholders, the managers, and the employees, the workers, okay? And they're all part of what we call the internal stakeholders. On the other hand, okay, we have the customers, government, the local community, banks, and the suppliers are part of there are groups of people who are part of the external stakeholders. They are not owners, they are not working inside the business, but they have this huge impact on the business activity. I would like to share the concept of the idea of what we call the stakeholder concept. Again, stakeholder concept. Okay, the stakeholder concept is the idea that businesses and their managers, again, the businesses and their managers have responsibilities to many groups, not just the shareholders. Again, when we say businesses, okay, the stakeholder concept is the idea that the businesses and their managers, the managers of the businesses, have responsibilities to many groups. And when we say groups here, I'm talking about the stakeholder groups. Okay? The managing, remember the idea earlier about the shareholder, the shareholder thing, right? The shareholder, the management, uh, and, and the team have this responsibility over the shareholders, their shareholder value. Okay, now I'm talking about the idea of the stakeholder concept. Okay, so the business has the responsibility for all the stakeholders. Now, why? Because, again, remember, all stakeholders have impact, okay, on the business activity. Once the management of a business change the business objectives, then there's the impact on stakeholders. And there's always a conflict, that's for sure. Okay, any any objectives often have this conflict, because we all know that it's really impossible for a business to satisfy all stakeholders all at the time. Okay, I mean, business cannot satisfy all. I mean, how many stakeholders do we have? Like one, two, three, four internal stakeholders, and we've got one, two, three, four, five. Yeah, there are five. So there are like nine, okay, or more than nine stakeholders that the business or the entrepreneur, okay, must must satisfy. So yeah, all the important business decisions must involve some stakeholders gaining and some losing, and therefore a compromise might be necessary. So if you're a manager of a certain business, you have to you have or a managing director, okay, you have to make sure that you know your objective. And once you know the objective, you have to think if there's an impact, okay, it can be a positive or negative impact over the stakeholder groups, okay. So if you're a managing director or part of the um, what's this board of directors or even the CEO, you have to understand that you need to make sure that most or majority of the stakeholders must be satisfied. Another concept is shareholders are always stakeholders, okay? A shareholder is part of the stakeholder in a business. Remember, shareholder are the owners, okay? So owners are part of the stakeholder and they are internal. But stakeholders are not always shareholders, okay? Like a simple wife, simple mother can be a customer if she buys her grocery, but she doesn't have time to buy some stocks at the stock exchange. So a simple customer is not always a shareholder. Okay, and okay, the last part of the text is this about the private sector businesses have different objectives, okay, to public sector organizations, and the BKH is also planning to expand by taking over another insurance company. So yeah, I think this one is self-explanatory when it comes with the public sector and the private sector. Okay, private sector is a kind of business. It's any business owned, run, or controlled by private individuals, and the objective of any private company or any private businesses is, of course, profit. On the other hand, when we say public sector, it is any business owned, run, or controlled by the government. Okay, so you've got the clue: private sector, private individuals; public sector, government. Okay, and the objective of the public sector is for the welfare of people. So BKH, um, you have to identify what kind of sector is BKH. Is it the private sector or a public sector? And at the last sentence is, um, if there's a growth, okay, they need to expand. BKH will expand their business, okay, and in order for them to expand this business, we need to say the size of the big business will be, you know, will be growing, okay, um, because of this external growth. Yeah, external growth by using the takeover. Okay, so there are two kinds of external growth. A business can expand by simply joining, okay, joining or what's this, by having a merger or being a merger or a takeover. So when we say a merger, it means that the directors and the shareholders of two businesses agree to join together, okay, to form one huge business. Again, it's a mutual decision, which means that both companies agree to combine, okay, to connect, to become one entity or company. That is part of an external growth. Another um, another way, another way of integration, okay, another way for the external growth is a takeover, also known as the acquisition. Wherein the company, there's a huge company, a very successful company, buys more than 50%, again, more than 50% of shares in another company. So this one is the survival of the fittest thing, wherein there's the purchase, okay, a large company would purchase, would buy the smaller company. Now, why do you think that the large company will buy a smaller company? Number one, probably the smaller company is suffering from, debts, debts, yeah, that's debts, or probably the smaller company would need to shut down, okay, and there's like one potential huge company who would which would purchase them. So that is what we call the acquisition. Another, yeah, but take note, it's more than 50% of the shares of another company. There's another one, to avoid the competition, to avoid a very tight competition, then the large company would buy the smaller company. That's also what we call the takeover, takeover, also known as acquisition. So whether it's a merger, whether it's a takeover, the the idea here is expansion, growth. Okay? So there are two ways for company to grow. It can be in a form of merger, it can be in a form of takeover.